Alright. Hey, what's up? Welcome back to day 21 of IntelligenceMaxxing. So, right now in this stream, gonna review some of my lectures for today. Was able to go to all my classes. A few things that I want to talk about and review, and mostly has to do with my institutional asset management class and also my valuation class. And I have some stuff here. Yeah, there's a lot. So I guess we can just start diving into this, see what's going on, and probably create some flashcards. So let's take a look here. And BMGT 726, so that's the institutional asset management class. Today we talked about how private equity funds, how they consider their different incentive structures and fee structures. And so when you're fundraising, usually what's going on, to my understanding, is these private equity firms kind of go on a marketing campaign tour where they look at different possible investors. These investors could be wealthy individuals, these wealthy individuals, pension plans, endowments, other institutions that are maybe looking for attractive investment opportunities. And during this marketing tour, the private equity firm usually specifies some type of fee structure. Most common one I think we know of is 2 and 20, so it's 2% of assets or capital commitments and 20% of profits. So I'll come back to assets or capital commitments because that's something that is I'm still unsure about whether or not usual, I guess, fee structures, how they determine what the fixed cost or the fixed percentage is from. And so this is kind of going to the first bullet point here of how private equity firms market their funds. Usually they're actually not allowed to make any advertisements within the public news. And so what they do is they have a personal contact list or maybe a network of clients that they pitch their idea to, their investment opportunity. And the actual process of buying out a company, so private equity, they usually engage in leverage buyouts. So they're really in charge of just buying out an entire company, probably through the process of fundraising portion. So it's kind of equity, but also borrowing money. So that's the debt. And usually, in the past, the way it's been done is with referrals. So within the private equity world, I'm sure that there's very well-educated people, and these people are connected to other well-educated people, possibly in the world of high finance or maybe corporates world. So most of these guys probably have a strong alumni network, went to some Ivy League schools, and they know accountants, lawyers, and bankers. So these are probably going to be the guys that are going to refer you to possible companies that are looking to exit. And so there's also this idea of this confidential information memorandum. So I think it's called a SIM. And this is something that investment bankers, this is more within their space. I believe it works on, for sell-side investment bankers, these guys are the ones receiving the SIMs so that they can look at different target firms that are looking to exit or looking to be bought. To double check on that, so what are differences between VC and PE leveraged buyouts? So when we think about venture capital versus private equity, and there's kind of a big difference in terms of what the underlying commitment is. With venture capital, the purpose isn't to really buy out an entire company and run it on your own, but it's really to invest a small portion within the entire business and possibly adding a few members to the board seat, maybe providing some type of guidance to the CEO or maybe installing a new CEO. So VCs, they take ownership, but only partial ownership of the business, while private equity firms, what they'll usually do is they'll buy out an entire company and install new managers, maybe new executive teams, and I think Possibly they'll harvest their investments after that. Maybe they'll invest or they'll harvest their investments after that, meaning I think it's called a sow and harvest or reap and harvest type method where you put down some type of capital to invest in a business, and then let's say 5-10 years down the line you make an exit and try to sell the business off, or maybe IPO. So that's another alternative. I think those are the two big differences. So that's what I have here. What is okay? So this question about what is the gap between ownership and control, this is something we talked about with how public companies today. So these public companies, the way they're structured is you have common shareholders, which you can think of as the owners of the company. So these are the people that have shares, individual shares, or maybe multiple shares of the business. They're the owners of the firm. And then you also have the board of directors and possibly the executive team. The executive team is usually the CEO, CFO, CMO, all these C-suite executives. And then the board of directors is kind of this upper level management that picks and chooses or maybe tries to act in the best interest of the shareholders. And there's been this dilemma between, do the owners actually have control over what goes on in a publicly traded firm, or just any firm in general? And I think the takeaway is we're not too sure as what the real answer is. At least in my class, we weren't too sure. And maybe that's something I could do more research in. So next bullet point, how do VCs and PEs find information about private firms? Yeah, so this is kind of interesting because it seems like one of the main ways that private equity firms, how they actually do their due diligence or information gathering, it's just by talking to employees of a firm that they might be targeting for a buyout. And I don't know how suspect this is. It seems kind of like this backdoor shady operation where you're going directly to maybe one of the employees and you can have some type of whistleblower. I guess that's what you could call it. Usually, at least according to my professor, private equity firms will provide these employees some type of incentive to actually spew information. So I think that's definitely an interesting thing. Maybe I could do more research on that because I'm not 100% sure if that's like the go-to strategy. Okay, so next moving on, what is an earnout? Okay, an earnout. So I think that's something where it's more common on the sell side. When you're a company that's looking to exit, then instead of receiving a lump sum or the entire purchase price at the dates of selling your business, what is going to happen is usually there's kind of these benchmarks that your company has to meet or the company that you're selling has to meet, and then you'll receive some compensation based on that benchmark. So I think maybe a good example could be, I believe VF Corp acquired Supreme two years ago, and part of that acquisition on the Supreme side is the owners will receive, I believe, 500 million. It could be a little bit more, a little bit less, based on specific revenue goals if they can hit within the first year, second year, third year. And this is a company that I've been trying to look at recently. It's been facing some problems within the apparel and footwear market. What I've found is I don't think Supreme is doing as well as it expected. And so the owners in this case will not receive that purchase price or the promised purchase price based on some type of benchmark because it was never reached. So I think that's the basic idea of earnouts. So it's a way to benchmark performance on the seller side, person selling the company. All right. Yeah, I think it's a good way to think about it. So has the income gap improved since zero AD? Yeah, so this question was really, I would say, probably related to the idea of when you look at today's income inequality in the U.S., you see that maybe there's a top 1% that owns a lot of the assets within the U.S. economy. And I've wondered if that's been the case in historically and whether or not people have had greater income inequality since the beginning of time, or 0 AD. So what is that? The medieval times, maybe the Roman Empire, and then medieval ages, Renaissance. There's these different time periods. I kind of forgot all this stuff in world history, but I didn't really find anything conclusive. Just the fact that today, with Western civilizations and more developed economies, people even in the lowest brackets, the income brackets, have substantially better lives compared to people 500 years ago. Nowadays, you see people life expectancy being all the way around 70, 80, and so even if you're in the lower tax brackets or the lower income bracket, you're still living a pretty substantial long life. Maybe it's the type of life you're living that's probably different. I'm sure there's still a lot of suffering involved. So that's probably the main takeaway. All right, what is the principal agent problem? The idea that a principal. These three are all pretty much interrelated. The principal agent problem, moral hazard, and I think there's one more, conflict of interest. So those are our main three ones, and these all reflect the same idea of when you hire a person to act or a company to act on your behalf, there's always probably going to be a conflict of interest problem that might happen. And so I think specifically with this principal agent problem, this is the main idea that in principal, so I think that's the owner, that has different goals / objectives compared to an agent. Okay, that's what I have in this one. So an agent authorized to act on behalf of a principal. And that's kind of the big idea. It's like, okay, if you're an owner of some assets in the context of private equity, so you're the owner of, let's say, $1 billion, and you hire an investment manager, so a private equity firm, to commit that $1 billion and invest it in a leveraged buyout or maybe multiple leveraged buyouts. The principal might just pocket the money and not make any investments at all. The agent might pocket the money and just not make any investments at all. And so there we have a principal agent problem. Yeah, and this exists not only in the finance space, but also with lawyers, real estate agents, maybe even doctors, anyone who you're entrusting some part of your life, I would say. Okay, these bullet points are interesting because then we start talking about the idea of how do you align incentives of private equity managers or just any type of investment manager in general if you're thinking in the shoes of an endowment or a pension fund where you have to allocate different amounts of capital to different types of asset classes, and also after allocating those to asset classes, allocating those to different investment managers to invest on your behalf. And I think the way that we talked about in class was David Swenson. He is he's the late manager of the Yale Endowment. And so what he really tried to do with hiring private equity managers was he would really create these performance bonuses. He would try to allocate a lot of the fees aggressively towards, I guess you could say, performance incentives instead of just day-to-day management. And so let me try to explain that real quick. There's this concept called carried interest, and this is the idea that private equity firms are able to earn a return on the profits that they've generated for the fund. And so this is just the idea that you're going to let the actual fund manager, the private equity fund manager, to get some of the reward on the fund that they're running. And that was one of the key ways that David Swenson was able to align incentives with these private equity funds or private equity managers, was offering this carried interest so that the underlying private equity firm would want to maximize their profits by maximizing the return on the fund. And then here in this bullet point, I have this idea of the 2 and 20 system. This is a commonly used measure of, I guess, commonly used fee structure. That's what the word is. So the commonly used fee structure is 2% of some type of fixed proportion of capital commitments, maybe capital invested or assets under management. So that's, again, that's something I said before, and 20% of profits. And really, what the 2% is, it's just a way to help with the private equity fund afford its day to day operations. So, pay the salaries, the base salaries of the different people working for the firm, and maybe paying off the databases, all of the due diligence resources that the private equity firm needs in order to find attractive investment opportunities and make those investments and help manage the business. Okay, calculating profits. This is something that we talked about, but we really didn't dive deep. It was more of a, okay, calculating profits for private equity firms is pretty hard. It's a very elusive process that isn't fully transparent. And so that's something to think about. I guess maybe if I have some time, I could look into it a little bit more. Okay, and then there's the idea of invested capital versus committed capital. So this is what I was talking about earlier with the 2% of underlying invested capital versus committed capital. So usually I think how private equity fundraising works, you're getting investors to commit a specific amount of capital. Let's say you have 20 investors, all of them pitch in $100 million, so you have $2 billion in the fund. So that's your committed capital. But your invested capital is how much you've actually spent of that $2 billion on the actual investments in the fund. Or so that's probably going to be purchasing companies. And let's say you spend $1 billion purchasing 2 or 3 companies, and you still have $1 billion left over to invest. So in that case, your invested capital is $1 billion instead of $2 billion. And the 2% now is 2% of billion versus 2% of 2 billion. And with that idea, there's different types of drawbacks, maybe you could say drawbacks and possibly some pros. So I guess pros and cons. There's pros and cons between the two different ways of thinking about what to actually I want to say tax, but I'm not too sure if tax is the right word. I'll just use that for now. Okay, what are the drawbacks of invested capital and committed capital? Okay, so this is what we're getting to here with invested capital and committed capital. When we think about the incentives to the underlying manager, when you're looking at the invested capital, you might want, okay, so I think one drawback could be it might misalign manager incentives so that they'll immediately invest all of their capital all at once so that they can capture the 2% fee, right? And that might mean that they're not really doing the due diligence necessary in order to make a good decision, and they're probably being too quick to enter into a deal. Now, making incentives or taking a percentage of the committed capital, I feel like this could also have a drawback where you're paying more in per dollar terms compared to, let's say, the invested capital if the company hasn't made as much investments. And so I guess there's drawbacks. In the case of committed capital, you might not have the problem where an investor or a private equity fund manager is going directly into the market as fast as it can. But it also might mean that the private equity manager is not in a hurry or is not as urgent and doesn't really care about making really good investments because you can always get that 2%. Yeah, so those are some possible drawbacks. I feel like maybe there's a bit more if you dive deep into kind of discussion between the two, but I think this is a pretty good high level understanding of what's going on here. And then there's also the timing impact of fees. So this one I might come back to because I remember we had a small discussion about this, but it kind of went over my head, I'm not gonna lie. I think it has to do with the fact that if you do pay fees, let's say on a quarter to quarter basis, then there might be a chance that the private equity fund manager tries to do some type of manipulation in the books in order to elevate the fee level. And this probably is most apparent in the case where the percentage is a percent of the assets or the fair value of the assets. Yeah, so there's that to consider as well. Carried interest, how might carried interest harm incentives? Oh, yeah. So this is a good bullet point actually, because you might think that, all right, if David Swenson's really focusing on carried interest as a way to incentivize managers, probably it's the best thing that can happen. There's no drawbacks. But I remember one student talking about how when fund managers are underperforming, they're not earning enough money maybe on the day-to-day basis just from the 2% or whatever percentage of, let's say that's a fixed cost, right? So they're not being able to capitalize on the 20% return on the profits, and maybe the fund managers, they're starved of bonuses and they're really money hungry. So what they could do is, in order to elevate their expected return, they really make these risky purchases. And so maybe a company has, let's say, 10% chance of going under. No, sorry, 10% chance of making billions, but a 90% chance of going under. I think at this point, maybe the fund managers are willing to take the risk to be able to compensate themselves handsomely instead of making a really intelligent, I wouldn't say safe, but maximizing the risk-adjusted return. Okay. So what is Warburg Pincus?
Like as soon as like you left, the pizza went downhill at Papa John's. Like when Papa left, the pizza went downhill. But now Papa
got the secret ingredient.
Yeah, they took out the secret.
They took out the racism and the gold.
Yeah.
They got paid advantage.
Okay.
Oh, I didn't know
What would David Swenson? Okay. What does Warburg Pincus think about new fee structures for private equity? So 1.5 minus 15%. Could be that the fund doesn't. Okay, so I think this one is talking about this bullet point is talking. Okay, I just want to make sure that's. Wait, is this not? Oh man, come on. All right. I don't think my actual. Yeah, my page is frozen again. Shit. Okay. So let me fix this real quick before I continue. Alright, hide OBS for capture. Okay, I think this should be good now. Let's order this back so I can see myself. Alright. And now let's see. Oh shoot. Alright, here we go. Nice. Okay, it works now. Okay, so let's go back to this question about Warburg Pincus. So Warburg Pincus is just an investment private equity fund manager. And this project, or this case we were reading about this week, talked about, I think, Warburg Pincus in the 2000s, how they introduced this new fee structure for their private equity firms, or for their private equity funds. And I think the going rate at the time was 2% to 20%, 2% or 20%, 1 and 20. And in this case, Warburg Pincus had a 1.515 fee structure. And so we were talking about today why they might be going against the grain here. And there's a few different philosophies I think we can probably think about here. So first one is that if the fund doesn't do well, or it could attract customers to invest in future funds if private equity takes off. Okay, so I'm reading these two bullet points, and I think the first scenario is Warburg Pincus can be thinking about, okay, the 15%, we're going to lower the amount of incentives and increase the amounts of fixed 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 percentage in order to compensate for the fact that, hey, maybe we're not going to do as good in the future. And so in order to ensure that we're getting a consistent return, we'll do 1.5% instead of 1% on some type of committed capital. The 15% in this case is lower than 20%. So that means that, and it's staying consistent with this scenario, the company may not be able to generate as high returns, and so they're fine with willing to take 15% compared to 20% of the underlying returns. The other side could be that Warburg Pincus thinks it could do really, really well, and in order to lower the profit incentive, I think this is a time where pension funds and other endowments besides Yale were really looking at private equity as a feasible place to invest in. And so this was in the 2000s. I don't think many pension funds, states, local, and even company pension funds were really thinking about private equity at all. Maybe only until recently. Most of them were doing standard 60-40 portfolio splits between stocks and bonds, and maybe dabbling in real estate. So I think this could have been a case where Warburg Pincus is thinking that they are going to do really well in the future. And so in order to attract new investments from other clients, they'll see that Warburg Pincus has a really stellar track record, has the lowest fees out of all of the different fund managers, and they'll go with them in the next fundraising round. So that's two different viewpoints. I'm not entirely sure which one is right. Maybe they're both right. I don't think the case really went into the details of what's going on there. And what would David Swenson think about fee structures? Going back to David Swenson and his philosophy with portfolio and asset allocation, choosing investment managers specifically, he would think that there would be a low fixed percentage that gets taken, and he would really emphasize on aligning incentives with higher returns. That's done with the 20% on top of the carried interest. Sorry, that's not on top of the carried interest, but 20% carried interest. Okay, what would investors think about fee structures today? So this case we read was about 20 years ago, and so a lot has changed since then. In the private equity space, we see that there's been a lot of money, there's been a lot of inflows into the industry, and people may argue that it's becoming saturated. Interest rates are also around 5%, 6%, the highest they've been in a decade. And so I remember just briefly reading through Howard Marks's, he had, I think, a quarterly newsletter called Sea Change, about describing how the effects of the shift between a pretty much zero interest rate environment to an interest rate environment. Now we have 5-6% effective, I think, a target federal funds rate. And so this might cause some stress within the private equity space, especially during doing leverage buyouts because of the higher interest rates, and also the higher cost of capital as well. So going back to this question, it's fund managers are probably going to honestly have the same questions and complaints in terms of fees that they had 20 years ago. Maybe it's even more emphasized now because of the saturation within the market. But, some things they would complain about are, okay, are you taking too much fixed percentage of the committed capital, or maybe you're taking too high of a percentage of the profits, or maybe you're not actually aligned with what our return objectives are. And so these are all valid complaints that fund managers, let's say investment clients, the clients might have for private equity fund managers. Yeah. And then we kind of delved into the world of bonuses and how that incentive structure might be set up within a specific firm itself. And there's an idea, okay, you have different managing directors within a private equity firm, and each of them are maybe tasked in different industries. They're specializing in, let's say, the healthcare industry versus the retail industry, or maybe even the finance industry. And these guys, they get bonuses on the carried interest. So the carried interest of the fund is funding their bonuses. Let's say that's, oh, getting a call, I think. Okay. I will pick up the stream soon. I'm gonna go study a little bit Chinese, and then I'll get back to this. But yeah, I think moral of the story, some takeaways are learned a lot about how private equity fundraising works, and also how to think about incentives and how fee structures work, and maybe how to think as in let's say a pension fund or an endowment, thinking about how they might think, how they might think. Yeah, that's kind of weird, but thinking about how they might think about making or allocating investments to these different private equity funds. Okay, with that, I'll see you guys in the next one. See ya.